Namaste traders. Today, we're breaking down the new SEBI rules that are going to change how we trade futures and options. These changes are big, and they're going to affect your trading, so listen up. Before we dive in, let's understand why SEBI is making these changes. In the last 3 years, 1.13 crore retail traders lost a whopping rupees 1.81 lakh crore in futures and options trading. Only 7 out of 100 traders made money. The number of retail traders has almost doubled to 96 lakh in just 2 years. SEBI is worried that many of us are treating futures and options trading like a Sata bazaar or gambling den instead of smart investing. Now, let's break down the new rules in a way that makes sense to us regular traders. New regulations. Limiting weekly index. Expiry to 1 per exchange. What's changing? From November 20th, 2024, each exchange will have weekly expiries for only one benchmark index. In simple words, currently, we have weekly expiries for multiple indices: Nifty, Bank Nifty, FINIFTY, and Midcap Nifty. After this change, each exchange, NSE and BSE, will choose only one index for weekly expiries. Most likely, Bank Nifty will be chosen for weekly expiries, while others will move to monthly expiries. How it affects you? Fewer trading opportunities. You won't have weekly options for all indices. Concentrated liquidity. The chosen index, likely Bank Nifty, might see higher volumes and liquidity. Change in trading patterns. Traders focused on weekly expiries of Nifty, FINIFTY, or Midcap Nifty will need to adapt. Real-life example. Let's say NSE chooses Bank Nifty for weekly expiries. You'll have Bank Nifty options expiring every week, as usual. But Nifty, FINIFTY, and Midcap Nifty will move to monthly expiry only. If you're a Nifty weekly option seller, you'll need to adjust your strategy significantly. Impact on different trader types. Bank Nifty traders might see more opportunities due to increased focus and liquidity. Nifty, FINIFTY, Midcap. Nifty weekly traders will need to shift to monthly expiries or move to Bank Nifty. Hedgers might find it challenging to fine-tune hedges for indices without weekly expiries. Pro tip: start exploring monthly expiry strategies for Nifty, FINIFTY, and Midcap Nifty. Consider how you can adapt your trading style to Bank Nifty if you're not already trading it. If you're not comfortable with Bank Nifty's higher volatility, start paper trading it now to get accustomed to its movements. Increased contract size for index derivatives. What's changing? From November 20th, 2024, the minimum contract size for index futures and options will increase from 5 to 10 lakh to 15 lakh. In simple words, the lot size of index option contracts like Nifty and Bank Nifty will approximately triple. For a single lot, you will need about 3 times the money you currently need since the lot size has increased. How it affects you? Much higher capital requirement. You'll need about 3 times more money to trade a single lot of options. This could lead to reduced participation, as many smaller traders might be priced out of index options trading. With fewer traders, market movements might become less erratic, potentially leading to lower volatility. Let's look at a real-life example using current option prices. Nifty, 25,800 CE. 3rd October 2024 is priced at 82 rupees per share as of 2nd October 2024, with a lot size of 25. The cost per lot is 82 multiplied by 25, which equals 2,050 rupees. After the change, assuming lot sizes triple, Nifty options' new lot size will be 75 shares. The new cost per lot will be 82 multiplied by 75, which equals 6,150 rupees. Increased tail risk coverage on options, expiry day. What's changing? An additional 2% extreme loss margin, or ELM, will be applied to short options positions on expiry day. In simple words, if you're selling options that are expiring that day, you'll need to put up extra margin. This extra margin is to cover potential last-minute big moves in the market. How it affects you? Higher margin requirements mean you'll need more capital to hold short positions till expiry. This might encourage early closure, as it could be more cost-effective to close positions before expiry day. Popular strategies like sell out of the money options on expiry day will become more expensive. Let's use current market data as of 2nd October 2024. Bank Nifty is trading at 53,000. Bank Nifty 52,900 CE. 9th October 2024 is priced at 440 rupees per share. Scenario: selling Bank Nifty options. You're selling one lot, which is 15 shares, of Bank Nifty 52,900 CE on expiry day. The current margin requirement, hypothetically, is 30,000 rupees. The new additional ELM is 2% of 53,000 multiplied by 15, which equals 795,000 rupees multiplied by 0.02, which equals 1,590 rupees. So, the total margin on expiry day will be 30,000 plus 1,590, which equals 31,590 rupees. Impact on different strategies. Option selling strategies will require more capital on expiry day. Intraday option buying might become relatively more attractive due to reduced competition from sellers who are deterred by higher margin requirements. The additional margin on the short leg might make some spreads less capital efficient. For example, a Bank Nifty bull call spread will require an extra 1,590 rupees in margin per lot on expiry day. Pro tip: consider closing your short positions a day before expiry to avoid the extra margin. If you must trade on expiry day, factor in this additional cost when calculating your potential profits. For longer-term trades, you might want to close or roll over positions before the expiry week to avoid this extra margin requirement. Upfront collection of option premium. What's changing? From February 1st, 2025, option buyers must pay the full premium upfront. In simple words, no more leverage when buying options. You pay the full price immediately. Your buying power will be limited to the actual cash in your account. How it affects you? Reduced number of positions. You can't enter as many trades as before with the same capital. No more lottery ticket approach. It discourages buying multiple far out of the money options, hoping for a jackpot. Better risk management. You'll think twice before entering a trade. A real-life example. Let's use current market data. Nifty is at 26,000. Nifty 25,800 call option, expiring on October 3rd, 2024, is priced at 82 rupees per share with a lot size of 25. Scenario: you have 20,000 rupees in your account. Currently, you might be able to buy 5 lots of Nifty 25,800 call options. 5 times 25 times 82 equals 10,250 rupees with some leverage. After the change, you can buy only 4 lots of Nifty 25,800 call options. 4 times 50 times 82 equals 16,400 rupees. Pro tip: start managing your capital as if this rule is already in effect. It will help you develop more disciplined trading habits and prepare for the transition. Removal of calendar spread treatment on expiry day. What's changing? From February 1st, 2025, The benefit of offsetting positions across different expiries, known as calendar spread, will not be available on expiry day for contracts expiring that day. In simple words, on expiry day, your short options won't get margin benefit from long options of different expiry. This applies to the contracts expiring that day. How it affects you? Higher margin requirements on expiry day for calendar spreads. This may force early closure of positions and affects popular strategies like future roll and option roll. A real-life example. Let's say you have a calendar spread on Nifty. You are short one lot of Nifty 26,000 call option for the current month, expiring today, and long one lot of Nifty 26,000 call option for the next month. Currently, your margin requirement might be around 20,000 rupees due to spread benefits. After the change on expiry day, your short option will be treated as a naked position, and the margin requirement could jump to 100,000 rupees or more. If you don't have this extra margin, you might be forced to close the position. Impact on different strategies. Calendar spreads will become more expensive to hold till expiry. Traders might close or roll positions a day before expiry. Diagonal spreads will face a similar impact as calendar spreads, requiring more careful planning for expiry week. Rolling strategies, like future roll or option roll on expiry day, will require significantly more margin. Pro tip: start planning your expiry day trades well in advance. Consider closing or rolling your calendar spreads a day before expiry to avoid margin shocks. If you must hold till expiry, ensure you have sufficient extra margin. Intraday monitoring of position limits. What's changing? From April 1st, 2025, exchanges will check position limits at least 4 times a day. In simple words, your total open positions will be checked multiple times during trading hours. You can't exceed your limits even for a short time during the day. How it affects you? Stricter enforcement means no more temporary breaches of limits. Potential forced square-offs could occur if you cross your limit, requiring you to close some positions immediately. This impacts intraday strategies, so high-volume traders need to be more cautious. A real-life example. Let's use current market data. Nifty is at 26,000 and Bank Nifty is at 53,000. Nifty 25,800 call option, expiring on October 3rd, 2024, is priced at 82 rupees per share with a lot size of 50. Bank Nifty 52,900 call option expiring on October 9th, 2024, is priced at 440 rupees per share with a lot size of 15. Scenario: the position limit for retail traders is 5% of the open interest in Nifty options. Let's say the current open interest in Nifty options is 200,000 lots. Your position limit would be 10,000 lots, 5% of 200,000. Currently, you might buy 12,000 lots of Nifty 25,800 call option at 10:30 a.m. and sell 3,000 lots at 1:30 p.m., bringing your position to 9,000 lots. At the end of the day, you're within limits. After the change, if a check occurs at 11:30 a.m., you'll be flagged for exceeding your limit and might be forced to immediately sell at least 2,000 lots to comply. This could result in unexpected losses or missed opportunities. Impact on different trader types. Intraday traders need to constantly monitor their positions relative to limits and may need to reduce the scale of operations. Algo traders must incorporate real-time position limit checks in their algorithms. Option sellers might hit limits faster due to higher margin requirements and need to be more selective with trades. Pro tip: set up alerts at 80% of your position limits. Regularly check the open interest to know your current limits. Consider spreading your trades across different underlyings, like Nifty and Bank Nifty, to avoid hitting limits in a single instrument. For large trades, consider splitting them into smaller chunks throughout the day to stay within limits. As we've seen, these new SEBI regulations are set to significantly reshape the futures and options trading landscape in India. Let's recap the key changes and their implications. Upfront premium collection. No more leverage on option buying. This will require more capital and encourage more thoughtful trading decisions. Removal of calendar spread treatment. Higher margin requirements on expiry day for spread positions. This could lead to earlier position closures and adjustments to popular rolling strategies. Intraday position. Limit monitoring. Stricter enforcement of limits throughout the day. This will require more vigilant position management, especially for high volume and algo traders. Increased contract sizes. Approximately tripling of lot sizes for indices like Nifty and Bank Nifty. This will require significantly more capital per trade and might price out smaller traders from index derivatives. Limited weekly expiries. Likely only Bank Nifty will retain weekly expiries. Traders focused on other indices will need to adapt their strategies to monthly expiries. Increased tail risk. Coverage. Additional margin on expiry day for short options. This will make holding short positions into expiry more expensive. These changes collectively aim to reduce excessive speculation and protect retail traders. However, they also present challenges. Higher capital requirements across the board, potential reduction in market liquidity, and the need for more sophisticated risk management. For traders, the key takeaways are: start preparing now. Don't wait until 2025 to adjust your strategies. Focus on capital efficiency because each trade will require more capital, so make them count. Enhance your risk management skills. With higher stakes per trade, proper risk control becomes even more crucial. Explore alternative instruments or markets if these changes price you out of your current trading style. Stay informed and keep an eye out for any further clarifications or adjustments to these regulations. Remember, successful traders are those who adapt to changing market conditions. While these regulations may seem challenging, they also present opportunities for those who prepare well and trade smartly. Thank you for watching. If you found this helpful, please like and subscribe for more insights on trading and market regulations. Stay safe and trade wisely.